Today, we're going to talk about the strategic tax architecture, 3 underutilized wealth levers for scaling your enterprise. I want to focus on this slide for a minute here because most people are founders. There's a difference between being a founder and a sophisticated operator. A founder typically is going to wait towards the end of the year when it's tax time to try and maximize all of their deductions. A sophisticated operator is going to be one that is using tax deductions and credits as a strategic instrument. As you'll go through these slides with me, you'll understand that the difference in outcomes is staggering. Today, we're going to focus on 3 mechanisms that separate $10 million enterprises from everyone else. It's going to be the R&D credits, the Section 1202, and the captive insurance. We're going to start with the R&D credits as growth capital. As I was telling you just a second ago, a lot of the clients, they're like, Kaylani, I need you to file my taxes and make sure that whatever I qualify for, that you are able to give it to me in my business. Here's the problem. You have to tax plan every quarter is what I suggest. A lot of founders and CEOs that I work with, they're always saying, oh, I don't have the time. Why am I paying you? You should be able to do this. But here's the thing. In order for me to know your vision, we have to sit down and discuss what I can do for your company based off what you tell me. Your financial statement needs to mirror your tax plan. Let's go over the strategic approach for the R&D credits. Now, a lot of people think that this is some type of refund. It is not. Let me explain to you how just by using the strategic approach, it's a reoccurring capital that you're able to have your business scale. Some of these industries and things that you can do is have software development, process improvement initiatives, and new product development. The capital redeployment strategy, first of all, it's operating cash free from the IRS payments, okay? The second thing is it's predictable recurring capital source. And thirdly, it's forward-looking growth fuel. Let's talk a little bit about the Section 1202, planning before the spike. Notice now it doesn't say wait till after, it's planning before the spike. What is Section 1202, you may ask? A qualified small business stock exclusion. So you can exclude up to 10 million in capital gains, which is the minimum, and you can reach all the way to 15 million depending on your investment basis. Section 1202 of the Internal Revenue Code allows founders and early investors to exclude substantial capital gains from federal taxation when selling qualifying company stock. So, a lot of people ask me, what is the difference between an S Corp, a C Corp, a LLC? These are one of my hidden gems of why I always say it is amazing to have a C Corp, also a holding company for all of your other entities, because this Section 1202 right here is one of the reasons that you can utilize it to save a lot of money, okay? Not hundreds and thousands, millions. So let's discuss a little bit about the planning window. Here we go. Company valued at 2 million to 5 million. Before investor driven, my favorites, C Corp conversion. Before revenue pushes past 50 million gross assets, and a 5-year minimum holds required. As you can see, the sophisticated planning versus the no planning. And this is why I tell people they are cringing at tax time, they hate tax time, but the people that I work with, they love me and they love tax time because they understand the importance of tax planning. They understand the importance of quarterly tax planning and what it can do for their business, not just for the today, okay? The goal is always to strive to leave a legacy behind. So not only are you tax planning, which is a myth that you're just doing it for the year, you're doing it for a lifetime. Now, sometimes throughout the year, you may have to pivot, but if you are a successful, established founder, you understand the importance of pivoting. Lastly, we're going to talk about the captive insurance as a risk architecture. Here's the reputation problem. Why does it have a bad name? It's marketed as aggressive tax shelters, IRS scrutiny increase, and conservative advisors become skeptical. The problem is, if you are doing everything right, one of the IRS codes simply states, if you are a private business, and it is a reasonable deduction and you have your written documentation, it will fly through an audit. If you do not have all of your documentation, if you are not together, if your books are a mess, absolutely be scared of an audit. But if you are doing everything that you are supposed to be doing, working with your firm, working with your team at the firm, hey, utilize it. The whole point is to save some money to reinvest into your enterprise to scale it. Captives done right. Product liability gaps. Supply chain disruption. Key person dependency. Regulatory compliance risks. Industry-specific exposures. Dual function architecture. So I want to stop here for a moment because I know I'm throwing a lot out. When you are tax planning as well, I want to let you know, founders, CEOs, high net worth leaders, you don't have to know everything, but you need to know at least the basics. You need to understand that you don't need 1,000,001 enterprises to try to save yourself some money. It's all about the architecture. It's all about keeping it simple. It's all about how the value retention is going to help you, such as the captures underwriting profit, retains premium economics, builds protected asset over time. Again, as I just stated to you, we are always looking for long-term wealth accumulation. Anything short-term is not worth having. Some of the long-term wealth accumulations that are properly structured over a 10 to 15 year period accumulates 2 million to 5 million in retained earnings, a credit protection, tax advantage growth, and it eventually flows back to the business owner. As to why I tell a lot of my clients, when you have companies, when you have assets, utilize your trust. That's an instrument. Utilize that architecture. Going back to the parent company, using those two together to minimize your risk of someone being able to take it, and two, so you're not paying all of these taxes. Of course, we love paying our taxes. If you are anywhere in any country, as you know, I deal with not just USA clients, but clients internationally, everyone is responsible for taxes. But every country has amazing loopholes that will assist you to be able to keep some of your money back in your pocket if you do everything strategically. The 3-lever framework is R&D credits again, the Section 1202, and the captive insurance. Implementing principles. Start early. I cannot stress this enough. If you've not heard anything else in this video, please, please, please do not wait until tax time for your accountant to work a miracle. Think structurally. Think, how is this not just impacting me, my family, leaders, the community? What legacy are you wanting to leave behind? Maintain integrity. Using mechanisms as intended, not as loopholes. Not to just say, when I say loopholes, I don't mean where you are intentionally trying to get over on the system. When I say loopholes, I mean to assist your business legally to be able to minimize your tax liability. Tax strategy at this level isn't about reducing what you owe this year. Okay, I just got through telling you guys this. I'm going to read it to you again. So hopefully by the end of this video, you are understanding the importance of tax strategy at this level isn't about reducing what you owe this year. It's about building structural advantages that compound across decades. The same thing that whether you remember in school, whether you're a parent or you're in school, and they always say, anything worth having is worth the wait, the hard work. Tax strategy, I am here to tell you, if you think this is a one done, thank you, Sam, ma'am, it is not. This is something that requires an accumulation of time, dedication, and principles to get you to the next level that you are striving to be. Some recommended actions that you need, and I suggest that you look through your own taxes. Number 1, audit current R&D activities for credit eligibility. Number 2, review your entity structure for 1202 qualification. Number 3, assess operational risks for captive and feasibility. And number 4, engage specialized advisors who understand architecture, not just compliance. This is a major, major thing. Just because you have a CPA, just because you're working with a firm does not mean that they are tax strategists. This does not mean that they are advisors.